Perfect. Dear ladies and gentlemen, we are extremely pleased to welcome you to today's quarterly update call from SIA. We have been extremely happy with a lot of people, a lot of investors and friends coming to our third Swiss Value Day 2 weeks ago in Zurich. We had 145 people joining us there. And we will have our next, the 7th Natural Resources Day in Zurich on the 12th of September. So we'll have a very, very busy agenda. We have already a very nice group of 35 people here. It's summertime. We are extremely pleased with the feedback that actually we get in the conversation that we have. Like always, feel free to contact us also in the meantime. We are there to answer your questions. And we have a very tight agenda. And with that, I would like to pass on actually to Marcos.
Yeah, good morning, everybody. Thanks a lot again for joining the quarterly call. I'm going to start with the macro perspective. You know very well, but we have a base case scenario in macro terms, not because we use the macro to guide our investments, but because we try to avoid risks. So if you move to the first slide, you can see that we always ask ourselves, where are we in the cycle? Still, we are in a very long economic upcycle. This cycle, in our opinion, started in 2008 or 2009 after the global financial crisis. So we are talking about 15 years. In this 15 years, we had a lot of issues. We have the European crisis, 2011, 12. We also had the Chinese slowdown in 2015. Then we had the fear of a recession, global recession in 2018, and finally the COVID-19 crisis. So, 15 years of a long cycle, but plenty of storms or bumps in the road. On the COVID-19, which is the last crisis, was a recession in 2020, very fast global recession, also fast recovery in 21 and 22, held by a fiscal impulse in the US, in Europe, and many countries. So this on a post-COVID, I'm talking about 22, led to inflation and high rates that started in this year, in 2022. And fiscal impulse started to fade in 23, 24. So where are we now? Basically, we are in the final stage of the slowdown, in our view. And this slowdown is being very well managed by the central banks. So we think that we should see a recovery in 2025 following interest rate cuts and China improving. Moving to the next slide, I'm going to just give a brief explanation of 3 or 4 macro magnitudes. On industrial production, nothing has changed. Manufacturing PMIs are still weak. US and Europe below 50, and China only slightly above. We are still in a correction in an inventory cycle, so the inventories are still down. And we were expecting the drop by mid-year, but we think it's going to take more time. Europe is still very weak, and Germany is very weak. So probably the down cycle in inventories will take until the end of the year, and the new restocking for next year. So very much aligned with what we were saying. So, conclusion from an industrial point of view, Europe and the US will not recover this year. Moving to inflation, which is something we've been following a lot in the past 3-4 years, but now it's fading. You see in the charts clearly how inflation in developed markets and emerging markets are normalizing. So here, nothing really new from our perspective. We see that together with the slowdown, inflation will go back to more stable levels, but higher than in the 2010s. So we think inflation is going to be around 2.5-3%. Rather than below 2% in the past decade. And this is due to labor, inflation, and probably energy and food prices. Finally, on macro, a word on China, which is a very hot topic, obviously, always. China is again launching more measures to help the property sector. So there's a new TLAC effort, so to reinforce the bank's balance sheets. Also, local governments have a plan to buy housing stocks, although it's only 10% of the total. But, the government is little by little helping there. Also, they are focusing consumption, exports, and technology, energy transition. So little by little, the economy in China should recover. And in the end, the main problem, which is property, it's in the third year of crisis. Normally, historically in China, they take 2 years to adjust. Now we are in the third year, and at some point it will improve. We hope that it's going to be probably next year also in line with industrial and in line with the cycle overall. Final comments here, more geopolitical risk, as you know, with tariffs between US, Europe, and China. So this is a new risk to watch. So from a macro perspective and in our, intent to or try to have a view on the cycle, the conclusion is that we are having a very mild slowdown, which should be followed by a very mild recovery. So if you can pass to the next slide, it is really difficult in this state when you are at the end of the slowdown, if it is going to be a crisis or not, if it is going to be a recession or not, because now the slowdown normally, accelerates, but this time looks like the central banks are doing very efficiently. And also, we are not really identifying bubbles, we are not identifying banking issues, and we are not seeing large problems in sectors. So, we remain optimistic, cautiously, because we're still in a slowdown. And the problem is, if the slowdown is mild, also the recovery will be mild. So nothing really important then in this scenario for equities. So I will take the next part to take a look to the markets. We also like to take a look to the markets a couple of times a year to see where we are in terms of valuation. And if you move to the next slide, you can see that by factors, obviously value looks very cheap. You can see here the valuation of value and growth from the MSCI index perspective. So the index of value is trading at 13 times versus an average long term of 17 times, so a big discount, whilst growth is a bit above the average. Growth is 15 to 25 times earnings, and the historical price earnings is 24. So a bit expensive, more or less in line, value still very cheap, and this confirms our view that we entered in a value cycle. In terms of markets, in the next slide, you can see a little bit the valuation. I took the PE, which is easy to understand, and there's not too much to argue here. So I took the price earnings ratio 2025, you can see it in gray. So the US 19 times, versus historical 17.5, so expensive but not massive. Europe is very cheap, 13 times versus 19. Nasdaq is okay, 23 times. And then China, Brazil, Turkey, Russia, even topics are cheap. Obviously, emerging markets, every country has its own fundamental issues. So we're not going to enter here to discuss that, but valuations on a first approach look cheap, excluding the US, that is more or less fairly valued. Moving to the next slide, you can see the same analysis by sectors, and you can see that sectors are not really expensive. It's only technology that trades at 26 times earnings 2025. The rest of the sectors are below historicals. Industrials 19 versus 20, consumer staples 18 versus 21. Healthcare, even healthcare is cheap, 17 times. Then those sectors that are outstandingly cheap are materials, mining, energy, financials, and insurance. So you can see here from a sector perspective, there is not an overvaluation problem, and only tech is a bit overvalued. In any case, there's no bubble out there. Next slide, you can see our conclusion, which, from price earnings or first approach in valuation, it is not expensive. We need to highlight these magnificent seven, these Apple, Amazon, Google, etc., that are driving the US and global indices. I'm going to dedicate 10 seconds to give you some hints of what we think. We think that two of them are not sustainable in terms of business model, in our view. This is Tesla and NVIDIA. NVIDIA because of cyclical. And then, in the end, price earnings of 20 or more require double-digit growth forever, which means that, at some point, these seven magnificent cannot really continue to outperform. This would be our briefly comments here, although there's no time to go deeper. And then we identified on valuation a fundamental issue. And this is not really everybody talks about it, but if you look at margins and better capital returns on capital, they are all-time high. And they're all-time high by a big difference. So I'm talking about 5 or 6 points of better returns on capital invested for most of the sectors, excluding mining and energy. And this is very interesting from a social perspective. We feel, okay, it's not mathematical, but we feel that returns on capital have improved massively in the last decade and versus a much lower increase in labor wages, which is a kind of discrepancy that needs to be challenged. And also here at SIA funds, we expect higher costs in labor, in energy, in financing, also depreciation on higher capex, and we also expect higher taxes. So this will, you know, damage a little bit returns, but this is not the big factor on returns. So two solutions we would bring here in terms of this. Solution for the labor inequality in wages could be the combination of artificial intelligence and reduced working time. I think this makes a lot of sense, that people work less and less with the same salary and productivity increases. So time will tell if this is a solution to, you know, improve this inequality. And then high returns like now are normally eaten by a combination of competition and regulation. So these will happen as, you know, the books, the macro books or the theoretical books say, when returns are too high, you will see new competition. So that was for the valuation of the market and comments on the high returns. Let's move to the two funds. On the classic, if you go to the next slide, perfect. 8% year to date. I think yesterday is like 7.5, the most updated figure, 670 euros per share. So it's a good start of the year. We are not far from the target. The target is 690, so still have 4 or 5% to go. But, you know, I would advise not to try to time the market. Nobody can really time the market. And we really suggest everybody to enjoy the compounding of the fund, which is double digit, at least for the last 10 years. Best sectors in the first half of the year: aerospace, defense, semis, mining, and cement. And on the negative, pharmaceuticals, obviously we own defaults, and salmon companies. And here you can see the list of stocks that are up more than 20% and those that are down. So I'm not going to enter in a lot of detail, just as a conclusion. You know, defaults, ISS, Reckitt, and salmon are more or less 35%. Almost 40% of the fund, and they are negative year to date. So we still have a lot of value to unlock here. In the next slide, you can find the half of the book, half of the classic. So in a quick look, you can see the top positions, 43% of the fund in these names. Obviously, we try to respect our 4Gs, for this good business, good management, good balance sheet, good price, concentration and diversification. And I would highlight, you know, that nothing can really affect the whole, you know, portfolio. Most of the companies are multinational, so we don't have a country bias or a currency bias. Salmon farmers, we're raising now 15%. We have increased slowly, defaults, ISS and Reckitt. All of them are in kind of a restructuring process. And First Quantum has jumped into the list in the top positions because of the strong price performance. This is because the market is seeing negotiation between Panama and First Quantum coming. So just thinking about, you know, sometimes we don't respect one of the 4Gs. I was thinking about this, and in the end, the response is that there's one G that is more important than anyone, which is a good business. You know, when the business is good, like in the case of defaults, the rest of the balance sheet or management, even price, can be addressed. And I think good business, we are in good business almost everywhere. Let's go to the IRR and the intrinsic value. I'm very, very happy to tell you that the intrinsic value for the first time in our history, only 22 years, has exceeded 1,000 euros per share. So the intrinsic value now is 1,020, and we should be there in 3-4 years' time. You know, people tell me, hey, why are you so sure about this performance? It's because the book is so diversified. And the assumptions are so wide among these 35, 40 stocks that, you can make a mistake in one and a success in another one. So, historically, this IRR and this IV has been really, really resilient and sound. The updated IRR is 14.5%. So this is basically in the historical mean, between 12 and 17%, which means that the portfolio is not expensive nor cheap, more or less the same as markets. We keep our target for 24, 690, so almost 700 euros. But for those that are tempted to trade here and to time the market, which is again impossible, we confirm our target for 2027, 2028, which should be this intrinsic value of 1,000 euros per share. I'd like to comment a little bit on this. It's a chart which is a bit maybe aggressive, but it's the path that the fund should follow for 10%, which is our target. And you can see we started to publish that in 2022. So we've been more or less accurate the past 3 years because the market has been quite calm, 22, 23, 24. But we are raising our confidence that we should maybe overcome the 10%. Why? Because we are in a value cycle and we are value investors. Why? Because we are in a commodity cycle and we are heavily exposed to commodities in both funds. And we also think we are entering in a traditional CapEx cycle in energy and most sectors due to this energy transition. So we think that there's tailwinds that are going to help us to maybe beat. We also, since we did the management buyout in 2019, so now 5 years, we've done 12% per year. So maybe we are learning a little bit. And just again to repeat that these numbers are really, really reliable because they are based on a bunch of assumptions and a bunch of companies and divisions and margins and CapEx, which means that the whole thing is very, very resilient. And this in the next slide, you can see the proof that we are value investors. This is the classic trading numbers, 2025, 11 times earnings versus the MSCI at 17, so a big discount. We are value investors, and even if we buy quality, we buy it at a discount. The same with the price to book, 1.8 versus 2.9, and our return on equity from memory is 15, 16%. So we should be trading at least at between 2 and 3. So, in the end, this is a way for us to manage a little bit the risk, buying cheap and quality. For us, is the margin of safety that Warren Buffett always talks about. So that's for the classic. I'm going to dive a little bit in one investment case that Alex presented in our Swiss Day. It's going to be short, but let me sum up why we think ISS is a good investment. So the problem of ISS, why it is so cheap, is that it has had a very long restructuring process since 2018, so almost 5 years, 6 years. They sold non-core businesses, they sold some countries, they renegotiated contracts that were underperforming, 3 CEOs, unexpected problems like the contract with Deutsche Telekom or the French business. So a lot of stones in the path. But in our view, the restructuring plan is complete. New CEO, new management team, top level in our view. The company has shrunk. Now they have only 350,000 employees. You know that the company does cleaning, so it's labor intensive in cleaning offices, etc., and also catering and also facilities management. But the overheads went from 500 million to 350,000, which is massive in this restructuring plan. The targets are coherent, discipline bidding, focus on core clients, 4% growth, so 2% prices, 2% volumes looks achievable. Operating margins above 5%, very much achievable. And the balance sheet is now already at good level, below 2 times EBITDA. And you can see what the market now thinks can go wrong or fears. Basically, the market fears that working from home will reduce office space, so less business. Also, they fear the arbitration with Deutsche Telekom. There's a risk of more surprises, obviously, because the restructuring is not fully over. And also inflation. Now people are very, very afraid about inflation, and these guys have a lot of inflation impact because they have 350,000 employees. And what do we think? that working from home is going to be very gradual and that companies are offsetting less space with higher quality, which means more business, counterintuitively for ISS. Also, we think that following the COVID, there's an acceleration in outsourcing and the need of a very efficient cleaning, not to have any trouble in the future. We also think that with this number of employees, ISS can take advantage of digitalization and automation to help companies to be more efficient. And then, you know, it's very, very cheap. Free cash flow yield 13% next year. And you can see in the table, PE under 7 times in 2026. So for us, you know, we don't know what is our mistake, but we should here double in the next 3 to 4 years. Let's move fast to the natural resources fund, which is doing an exceptional year again. The fund is up 16-17% year to date. The net asset value of 175. Best sectors, mining, infrastructure, also energy are up. Energy and agri-food, sorry, are up low single digit. You can see the stocks here. Those that are up more than 20%. You can see the list. The worst stock also here, although, you know, overall with a fund up 17%, everybody is performing well. This is the 4th year of positive performance after the COVID-19. We got the low in March 2020, around 50 euros per share, and now the fund is 175, and the intrinsic value you will see is even higher. In the next chart, you can see the composition of our exposure now. We cut a little bit of copper. We raised a little bit on oil and salmon on valuation. So those on valuation, and we have some new names: BHP, Rio, Barry, Callebaut, Bureau Veritas, and Nutrien. All of them relatively cheap and high quality. And just to highlight here, our most important exposure are oil, copper 25% each, and salmon 18%. These would be our 3 most important exposure. Next slide, the intrinsic value, 240 euros. The fund, as I said, is 175, so still big upside to the intrinsic value. Remember that the intrinsic value is calculated on mid-cycle numbers. So we are convinced that the upside is much higher if we go to the higher part of the cycle, like in uranium. IRR 17.3%, 240 IV, this is mid-cycle. And the IV, why is it moving up? It's because of the rebalancing of the portfolio. We normally try to sell what is a bit more expensive, and we buy what is more cheap, trying not to go to higher risk stuff, so keeping the risk profile. As I said, we took some profit from copper. The first half was fantastic, with copper prices going up to $5 a pound. And we invested in some cheaper names. We know all of them, so they are all friends. And basically, you know, we think in the next 5-6 years, we should be able to overcome this 300 euros per share in the natural resources fund. Although first, the IV needs to get there. I'm going to finish well, here you can see the look through of the fund, which is trading at 10 times, almost 10 times earnings 2025. And this is very much in line with the sector because there's no big differences with the sector, but it is, you know, 10 times is cheap. And more importantly, the book value is 1.6. In my experience over 25, 30 years, this sector on the trough trades at 1 times book value, and on the peak, between 3 and 4 times. So you can see here that we are not even at the mid-cycle level, which should be 2 times book value. So still 25% to go, which would be very, very in line with our intrinsic value. So, you know, another checking of the intrinsic value of the fund, 25% more. Moving to the oil market, I always try to give a hint on what is going on in our main exposures in the fund, in the natural resources. In oil market, this is our view. We are okay for the next 2-3 years. There's enough spare capacity. There's enough supply for 24, 25, and possibly 26. And OPEC will still manage the production. So, you know, there's no really way to see why prices should fall down a lot or move up a lot. Although, you know, this sector always surprises us. If you do a regression with when you see the chart, on where the oil price should be at the level of commercial inventories in OECD, which is a high R2, a square bar, so almost 80%. So you see that prices should be around this 80 to 90 in the next few months. But this is important. Demand will continue to grow. In our numbers, 1.5 million barrels per day in 24, 25, and 26. This is not consensus. And in 1 minute, I will try to say why. If you divide the world in 5 parts on 1.5 billion people each, 4 of these parts, Africa, China, India, Middle East, and Southeast Asia, will continue to grow. So 4 out of the 5 parts continue to drive more and transport more merchandise, etc. So they are in a higher penetration mode, which means the growth will be higher. Out of the 4 end demand sectors, 3 will continue to grow. You know, airlines, of course, chemicals, heavy investments from a lot of countries in petrochemical, and diesel, because diesel is transport. So, you know, these 4 will keep growing. And finally, we did, as you know, a model on electric car penetration. And on this model, which is very sensible, we don't reach the peak until 2035. So, you know, the oil market is not really worrying the next 2-3 years, but in this slide, you can see why it is very worrying in 3-4 years' time. And we will test demand elasticity that, you know, is very, very high. So the big problem, as we stated many, many times, is the lack of investment, the lack of CapEx. And, you know, I like to attack this idea from, you know, the questions. In the end, we had shale growth or shale oil in the past 10 years. This shale oil brought 10% of the total supply. Shale oil is now mature, so growth in the next few years will be very, very low, in the hundreds maximum, unless prices go very, very high. But, you know, at these prices, we'll see very little growth. And then we need, it's obvious, we need another shale. We need another Alaska or another North Sea, because we've been living from the last findings. Now we need to get the new findings. So this is my 2 questions that I hope make everybody think. First question would be, what would have happened to oil prices if shale oil had not worked out? Yeah, you can imagine. The second question is, what will happen to oil prices if we don't find another shale oil in 2 to 3 years' time? And I can tell you, the prices will spike. So very worrying oil situation for the midterm, and we will try to make some profits here. On copper, just a slide, you know that it's 25. We've been selling a little bit because the run was fantastic in the first half, with stocks up 50-60%. And you can see in the chart how over the years, the base case scenario of mining plus probable plus possible reserves is not really moving up, and it's moving to the right, which means that really bringing new supply to the equation is super complex. We are talking about multi-billion capex. We are talking about high-risk countries like Congo, Zambia, even South America, like Panama. We are talking about environment, resource nationalism. We are talking about taxes. And you know, the last movement in the sector, BHP bidding for Anglo, really confirms these companies are buying, even paying a bit expensive rather than developing, because, you know, you take all these risks behind you. Just a word on, you know, to see what happens in reality. These guys, First Quantum, they invested $10 billion in Panama. They were there for many, many years. And once the mine was up and running, it was closed by the government on constitutional issues and, you know, trying to take this asset away. So, you know, the question is, what is the return on capital that you need to invest in Panama or even in the South, Latin America or Congo? So it's really a tough sector where to bring large projects into life. And my final comment on sector and exposure would be on salmon in the next slide. You can see that salmon have not done well this year. The stocks are sideways. It's kind of 15-20% from memory in the natural resources, 15, I think, from the natural resources perspective. So the sector is disappointing in 24, basically biological issues, so sea lice, virus, jellyfish, many other stuff. This led to lower harvesting, lower kilos, so it's more difficult to dilute fish cost. Then you need the treatment cost, then you need also sometimes to harvest because of these issues. In the end, higher cost per kilo and bad margins in first half of the year with very high prices. So let's say disappointing earnings, but look at the valuation of the sector. 2025 under 10 times the average, 2026 around 8 times, this with normal prices. And in the final slide on salmon, you can see that the sector is more or less doing what we were saying. You see that the prices in the past 5, 6, 7 years were around 60 NOK per kilo, so 6 euros more or less per kilo. And now they are jumping to 110 euros per kilo, more or less, 9, 10. And why? Because supply is not able to grow. In our numbers, supply can grow 4%, maximum 4% per year, because Norway and Chile are constrained, regulation and biological issues. Demand growth at constant prices, statistically, is 7-8%. And, you know, we are only eating salmon in US, Europe, and Japan, basically developed markets. Emerging markets are not eating salmon, so there's plenty of demand there. So we expect very high prices in the future, and very much, you know, the sector should follow this, in our opinion, once they tackle the biology. Conclusion. In the last slide for me, I wanted to highlight this because, you know, it's very important. If you look at the 10-year part of the chart, there's a negative correlation between this sector and the stock market, which is a very interesting aspect of the natural resources. The other aspect that obviously we try to take advantage of is the scarcity. So we always focus in scarce resources, copper, for instance, uranium, for instance, and this is a way we try to add some value. But it's very interesting to see that over 10 years, this sector is negatively correlated to the stock market. So interesting way to diversify a little bit. So I'm over for my part, and I hand over to Urs. Thanks a lot.
Thanks, Marcus. I will have a few words on the metals at the beginning. Let me start with an anecdote from some time ago. I remember in 2015, there was at the end of the year in Australia. As you have to know, Australia is 50% of the iron ore of the world, and iron ore is more than 50% of the whole export value of the continent of Australia. Therefore, you know, at the end of the year, every broker has an opinion on iron ore, a bit similar like probably every broker in Switzerland has an opinion on the SMI, at least in the old days it used to be. Today they have other things they're interested, like white shoes or so. But let me see, in iron ore, you know, the market came down from, I don't know, 114.11 to $30 at the end of 2015. And then, you know, these whole projections at the end of the year were saying the number one safe bet on the short side is iron ore. There's no other way that you can make money if you're shorting it. It's going to go down from 30 to 20 after it went down from 140 to 30. 2016, what happened? The opposite. As usual, when everybody agrees with these projections, particularly financial analysts, iron ore went from 30 to 60. Obviously, everybody was wrong. And then everybody said, you know, that's an unjustified rally because it's the brokers who are the ones who are judging if a rally is justified or not. And it's the Chinese housewives which are speculating in iron ore, meaning physical iron ore, meaning the Chinese housewives buy tons and tons of physical iron ore and put them into their kitchens. You know, that's obviously completely ridiculous. Now, we have explained quite a few times in the last, you know, the quarters or whatever, the situation in the metals. And let's take copper as the most important base metal and the biggest one. There was a huge short position building up in financial speculators, meaning CTAs, etc., which are shorting metals because of the recession. Wherever this recession is and whatever it might be. I mean, India is growing 7%. Germany might have a recession in real terms, but doesn't matter. But the problem is if you have a short position of financial participants, obviously you have a long position of commercials. And commercials is the physical end demand. Because in the COMEX, it's a company like Glencore or Trafigura, which has a structural long position due to their offtake agreements or mines, which the trading department is long, and then, you know, they hedge up some of this. So it's a normal position to be short from a commercial. And if a commercial goes long, which is rarely the case, it means that for him, it's cheaper to source the metal from a financial speculator, which sells it to them, and not from the mines or in the physical market. So we have, explained this quite often, and there were a lot of warnings, from Glencore and from Freeport and virtually from everybody in the physical trade. And then you see that the leading indicator are the treatment charges. This is the part of the refinery of the smelters which goes to the smelter, because the smelter sources concentrate, because the concentrate cannot be sold in a market. It's not a refined product. And the scarcer the concentrate gets, the smaller the part of the end copper price is what goes to the refiner. This is always a leading indicator of the copper price or all the metal prices. It's not so visible in other metals as in copper. So we saw these treatment charges going down already last year. And, everybody was warning of this. And now what happened? We had this huge delivery in, 1 month, I don't know exactly, 2 months ago. And of course, this financial industry can't deliver the copper. Obviously, they have to cover it. Obviously, because if you can't deliver it, you have to buy it. That's why you had this huge spike. And physical premiums went up to $1,000. Now you say that might be overdone. I remember physical premiums in nickel went once up to $3,000-$4,000, because this is not financial. This is not financial. It's not something like being overdone. You just need to have the stuff, as we have seen now in orange juice, etc. Of course, now this first extreme situation as the delivery month was over, and what the copper after the spike has consolidated, maybe 10%. But what's happening now? The warning thing is the treatment charges are completely collapsing now. So Antofagasta fixed with Chinese smelters at the end of the last year, treatment charges of $80 per ton for this year. Now, the indications are that these treatment charges recently, for the second part of the year, has collapsed to 20. I mean, this is virtually nothing anymore. I tell you, this is an extreme sign of a complete scarcity of concentrate. So I wouldn't be surprised that, contrary to all opinions, that these metal prices will go up much more than people can imagine. And this is always what happened historically. When you get into tightness situations, you don't have moves of 10-20%, usually doubles or triples and so, until you get enough concentrate, or it gets so expensive that some consumers say, okay, we won't stop consuming copper. Where is going to be? Like I'm saying, infrastructure, which is paid by the government, they don't care anyway about the price. All these problems are, these metal prices. When you build a house, you have $2,000 of copper. I recently saw Archer Daniel Midlands, which buys 15% of all the crop harvests in the world. Quite interestingly, they told me in food, 70% of the costs is packaging, virtually oil at the end, or paper, and 20% is transport. And the part which really the food is of the cornflakes you buy is 10% and less, so it's completely unimportant. So maybe the next slide, Alex. Now, what do we see in an even more important commodity than copper? Oil. And I'm following this International Energy Agency since 25 years. I mean, they are quite useful because their track record is virtually 100% being wrong all the time. I mean, they projected the oil market going to be 70 million barrels in 2030. That was 4 years ago. The oil market will be 110. So it's, 50% difference. And I have the impression in a recent time, they become just a desperate propaganda agency from governments and politicians to support this whole green energy transition, whatever, which obviously these people get desperate because it's not working and it's already over to the degree, at least what was said. We all see the problems. Now, what's the situation in the oil market? It's exactly similar like in copper. It was maybe, I don't know, half years ago. I've shown this already a few times. These are a few statements of people in the physical market. Saudi Aramco, which manages the biggest oil business in the world, predicts tighter oil market because of the issues Marcos has mentioned. The investments which collapsed. But obviously, we don't listen to the Arabs. They are probably not knowing anything. Financial people in the West are much more educated, like in copper, than the miners. Rosneft, we don't listen to them neither. They're managing the second biggest oil business in the world, obviously. Rising oil prices, inevitable due to shortage of investment, etc. And Vicky Hollow manages the biggest business in the US from Occidental. She predicts an oil crunch, a crunch in 2025 due to the same reasons. I'm saying a bit cynically, we don't listen to her neither. She's a woman, but she's coming from Alabama, probably not voting for the right party, for the commentators in the newspapers. So nobody talked about this speech in Davos. And, if she's right, I mean, this is having a huge impact. So these are the commercials. And Alex, the next page, exactly the same situations. That's, I have to say, that's two weeks ago, a maximum record negative positioning of the financial industry compared to oil. Never been as low, completely bulls crowded out, exactly the same as in copper, maybe a few weeks ago, a month ago. So let's see if this time is different, but I just would be very careful, because the track record historically is very obvious at these extreme situations when you have commercials being long and speculators being short. And if the similar things which is going to happen as we have seen in copper, the implications for the world economy and many other things are quite significant. Maybe on the next page, Alex. So we have always, I have to say, in our industry, people are maybe not aware, but the last 2-3 years were actually not very good years for natural resources because they were actually consolidating after the peaks in 21. Let's take oil. Oil is having had a peak of 140, I don't know, 2-3 years ago. Since then, it's consolidating. Copper was the same. Here is even a more extreme commodity I quickly want to mention. So there are always good opportunities. Potash. So the fertilizer market peaked in 2022. Very high grain prices, also this fear, Ukraine, and blah, blah, blah. And now, this commodity price has divided by 3. And of course, it's always the cure for low prices are low prices. With very high fertilizer prices, the consumption of the farmers, the affordability collapsed. It's not that they don't apply fertilizer anymore, so they just use up their inventory, etc. Now grain prices tend to probably turn on the upside. Fertilizer is very affordable, so the consumption is going to go up. And maybe an interesting thing is the deindustrialization in Europe, because fertilizer is virtually, it's very natural gas intense, so it's very energy intense, and the production in Europe is becoming structurally uneconomic. And I would advise that you read an interview given by the head of Ineos. Ineos is maybe from sports, the sponsor of the cycling team of Sharon Thomas. Unfortunately for him, he won't win the Tour de France because he has no chance against Pogacar. But the guy is said to be the richest person in Britain. and he's huge in chemicals. And I advise you to read this interview about the affordability and the production in Europe of everything what is energy intense, let's say chemicals. So now what happened, you know, that the imports from Russia doubled recently because first they stopped the gas, so we can't produce the fertilizer on our own. So we import it from Russia. And soon, you know, the Europeans will be forced to put tariffs on the stuff from Russia or even worse. And we have to import it from North America, from nutrient, like in LNG. So I think there's always a commodity, you know, where prices are low and obviously you get a good entrance point. And maybe to the last, Alex, this is a tactical model from Laszlo, which is helping us to be not completely wrong on the market timing. And you see we have all buying signals tactically in natural resources, in gold, in oil. And we have the opposite in, you know, these tech kind of things. It doesn't mean, you know, that the world falls apart, but I have also other indications. I recently read that the distribution, you know, from weekend and from strong hands like professionals, hedge funds in tech to retailers are at its maximum points. You know, the market breadth gets smaller. So we have these technical signs that we could see a bit of rotation as we have seen 2 years ago. And I just read, for example, the enterprise value of NVIDIA doesn't mean that it can't go up more and more, but the enterprise value of NVIDIA has reached 12% of the GDP of the US. So Cisco at its peak in the bubble 20 years ago reached 5-6% of US GDP. The enterprise value of NVIDIA is now the same as the GDP of France. It's 50% higher than the GDP of countries like Canada, Italy, or Brazil. If it goes up another 20%, it reaches the GDP of Germany or Japan or India. I mean, there's nothing bigger than anymore apart from China and the US. So that doesn't mean that it's turning, but obviously it can't go higher than the GDP of these countries at the end. So maybe, you know, to shift some profits to the things that get tactical buying signals, like we see in, you know, like value and these kind of things wouldn't be a bad thing. Suppose that you were long on the upside, which is not the case for me personally, but that's another topic. Thanks, Alex. That's from my
Thanks
side.
a lot, Urs. With that, I would like actually to take the last bit. The situation is I was actually looking from an asset allocation point of view at our funds. Because, I mean, today's asset allocation is very, very much detailed. Of course, you have cash, equities, bonds, alternatives, real estate. But if you then break down the equity part, you break them down in all different regions, sectors, and whatnot. So it's basically very, very difficult to find the right box for something which is the long-term investment fund classic, for example. And that is quite an interesting situation, because in my view, everybody is dreaming of long-term great returns of Berkshire Hathaway, or even here the case of the Magellan Fund from 1977 to 1990. Peter Lynch was actually taking over the fund manager roles in 77, when he was actually 33 years young, and the fund had just 20 million assets under management. And he passed it on to his next fund manager when it had a size of 14 billion US dollars. Of course, it has been a fantastic run with 26% compounding returns per year, beating the S&P in this case, because at that time MSCI World was actually not that much in focus, all by almost doubling, because the indices, the S&P at that time were doing 13% per year. Of course, in a phase of higher inflation, of course, in a phase where you basically also had higher bond yields. Now, I believe everybody is dreaming about that. But look at how the situation then really plays out. this great fund had quite difficult patches. One point in time, it lost 15% underperformance. Another point in time, it lost 10%. If you look at that in the more details, within hardly 2 months, Peter Lynch underperformed the S&P 500 by 15%. Slightly more than 1 year, between 83 and 94, he underperformed by 10%. And now here comes the fun part. Peter Lynch mentioned that quite often in presentation. There have been even studies on that, where he actually concluded with a great fund like the Magellan Fund, you basically find a lot of clients not being able to achieve not even positive returns. Why that? Because of trying to time the market. So I really ask myself, would there be a chance to maybe change this mistake that people always dream about the long-term performance, but that at the end of the day fail? And then I actually came to a conclusion, and maybe it's not the first time you hear that, but I think if you less to a pension fund, but more to a client, end client, I believe you can actually ask, or you should ask your end client, do we have a minimum equity exposure that we would like to keep at all times? Let's say this is 20%. If you have that, then in that box, I think you should buy things that you want to keep forever. Now, I'm not objective, of course. Therefore, I would argue in that box, I would put 2 or 3 value funds. And then close this drawer in here, open it only maybe once a year to rebalance the size on one hand, and secondly, to rebalance the manager again, because there is a classical situation there you have mean reversion among managers. The good ones slice them back, the bad ones give them more money, as long as they are actually offering you the same philosophy. I'm absolutely convinced that with a philosophy like that, in this bottom drawing, you will be able to finally achieve very, very good long-term returns because of the fact that you're actually compounding. And secondly, you anti-cyclically rebalance. And these are really very, very important long-term drivers. Now, in the upper boxes, of course, you can play index products, you can play regions, you can play sectors, and you can play themes. But there, I would actually use them much more tactically. Now, looking at our natural resources fund, of course, it's part of that box. It would be absolutely a must to look at that from a timing perspective, because you cannot just buy and hold like you could maybe do for value funds. Here, you really need to time the commodity cycle. Now, we argue, in our view, it's almost impossible, or it's actually impossible to predict short-term commodity prices. Differently, if you look at it from our standpoint, where you really focus your forecasting time to analyze demand supply pictures over the medium term, because then it becomes easier. Even more so, if you look at commodities, specifically in markets, where you have very long lead times to add capacity. Now, we absolutely think and are convinced that this cycle will end in a massive wave of new investments. You will have a lot of new funds coming again to the market with themes like that, because you need this money to create the next big cycle. To sum up and to conclude, we still believe we are at the beginning of a new commodity cycle that will take at least 6 to 7 years, as was already mentioned by Urs and Marcos. And we are absolutely also quite clear that this cycle, thanks to factors like ESG and the like, will most likely be even more extreme than the previous ones. Now, with my part, we actually would conclude and we would go to the Q&A session. Now, we already have received 2 questions on the Q&A chat. The first one was actually talking about or asking us, Marcos was asking us, what is the tax situation in the Norwegian salmon market? Maybe Marcos?
Yeah, sure. So as you all know, the sector went down a lot a couple of years ago because a new tax system. So taxes were supposed to go from 22 to more or less 50% plus, and then the sector collapsed. But the companies have reacted. So there's two things here important. The companies have reacted and they have split the businesses in 4 or 5 businesses, from genetics to smolt to farming to processing and to selling. So these 5 businesses, and the tax only applies to farming because it's when the fish is in the sea, which means that the effective tax rate they are paying, at least is what I see in the last quarterlies, is rather than 50, it is more 30%, 30 for the group. So the increase has been effectively from 22 more or less to 30, which is much less than what the market fears. And the second thing, which is even more important, that in the end, the profitability of a sector is not caused by costs, it is caused by competition. And competition here is very tight. There's 4 or 5 companies in Norway. Norway is 50% of the total supply. And then there is Chile with another 25%. And I guess Chile will also rise somewhat taxes in the future following the Norwegian. So in the end, you know, these guys will raise prices in order to be back to the normal profitability levels of the sector. So, you know, tax is a cost. If taxes move up to in the whole curve, then the price, you know, this will be translated to prices. So it's not a cost, it's you know, a market structure issue. So in the end, the company's reactions, 22 to 32%, and then our long-term view, which is more that the sector is still concentrated and oligopolistic and will push up prices if costs are up. These, you know, reinforce our positive view in the sector, and we are buying this year because the prices are weak.
Thanks a lot, Marcos. I mean, we actually internally have the saying that, you know, there is not the risk that governments will charge more taxes. It's actually a guarantee that they will sooner or later tax a lot of profit. But if you're in the niche markets where you can actually then pass it on to the consumer, then you will be safe. There was another question, Marcos, on Reckitt from Per. If we really believe that this company can turn finally the corner again.
Yeah, Reckitt is a tough call. We have, I think, 4 to 5% in the classic. Basically, this company bought in 2017, if I'm not wrong, Mead Johnson, a company of infant nutrition, the bulk in the US. So they, at that point, they had 3 businesses, hygiene, which is personal care and home care. Then they have health, pharma OTC, and then nutrition. And they thought that this could be combined, but the culture was very different. The production was different. The end client is different, and the consumer is different, which means that integration has been very tough. So since then, the company has been on the restructuring, 3 CEOs, different managements. And now the company more or less is back to a decent level of performance. The problem is that they had a problem in the US with a product of Mead Johnson, which is called Enfamil. It's a product for premature babies that they need a special milk. And this product, which is basically, you only have 2 products in the market, this one and the Abbott product. If the baby doesn't get it, the baby dies because it's a premature baby. So, but these products have side effects, and one of the side effects is that they can cause a thing that is called NAC, necrolysine, it's a kind of bacteria. I don't remember well the name. It's a bacteria in the stomach, and it can kill the baby, right? So, but this is in the precautionary statement of the milk, and also this milk cannot be bought by a consumer. It has to be given by the doctor. So, you know, this led to some court cases in the US, and the first case was quite negative for them. But we think there's no case here because it's a doctor prescription. It's well said in the statements of the medicine of the infant milk, and we think that the case is going to be not important in the future. So two things here, the restructuring is more or less over and the company is back to normal. And then the infant formula issue that has taken the stock down 20%, we think that this is a non-issue in our opinion, and this will be seen in the next few years. Otherwise, we were lucky here, and the COVID-19 in 2020, due to the COVID, these guys started to sell a lot of their best brands in hygiene. So Lysol, and the stock went up to 8,000 and we sold completely, and then we went back. So it has been good for us. We were there, we exited in 2020 with the COVID when the results were amazing. Then the stock went down again, and then on Enfamil down again, and we are back. So, you know, in the end, you take a look to this, and we think that the core cases on Enfamil are not really based. Legally based is not very, very strong. You have a company which is growing mid-single digit with margins above 25%, very nice returns, and the P 2026 that I looked recently is under 13 times, when historically it was 22 or 23 or even 25. So you know, if everything goes wrong, we'll get 4 or 5% dividend yield, some buybacks, and some growth, which is a 10% return. And if everything goes well, we should probably take this stock to a P of 20.
Thanks a lot, Marcos. Actually, we have additional questions. We will answer them directly because we are actually passing the hour. And there was a fun comment or question from Germany. If Switzerland has become the European football champion. Let's see about that. And with this final closing remark, I wish you a great summer. Don't forget to participate on the 12th of September at our Natural Resources Day. And my voice is leaving. Take care. Bye-bye.